Hi everyone. The topic that I have selected for today's discussion is important capital budgeting techniques. We'll be primarily talking about NPV and IRR because these two capital budgeting techniques are very often asked in the interviews, and it's very important to know this particular concept in detail. So, first, I'll start with NPV. So, NPV is nothing but the net present value, or it tells us how much money we'll be able to make from a project after adjusting the cash flows for time value of money. So, we take the cash flow stream, that is the cash inflows and cash outflows. We discount it using the cost of capital, and we get the present value of cash inflows and cash present value of cash outflows. Now NPV is basically the difference between them. So that, as we can see in the second point, NPV is equal to present value of cash inflows minus present value of cash outflows. So if my NPV is positive, it means that I am able to generate money or profit out of the project. So if it's greater than zero, we accept the project, otherwise we reject it. Second is IRR, that is internal rate of return. So internal rate of return is the rate at which my NPV becomes zero. Or we can say it tells us the returns we will be able to generate from a project in percentage terms. So if my internal rate of return is higher than the cost of capital means the cost of raising the capital. The raising, since we are raising capital, it may be from debt or equity. So whatever cost we bear, if my return is greater than that particular cost, we'll accept the project, otherwise we'll reject it. Third point is basically basically revolves around like situations where will we prefer NPV and where we'll prefer IRR. So first we'll discuss the situations in which we need to give more preference to NPV compared to IRR. So there are three situations basically. First is the case of unconventional cash flows. So usually in a conventional cash flow, at time zero, we have a negative cash flow, that is a cash outflow. And in years one, two, three, four, we have a positive cash flow or a cash inflow. In an unconventional cash flow, there can be negative cash flows or cash outflows after time zero as well. So in those cash flow streams, what happens is you might get multiple IRRs, because of which comparison becomes very tough. So in those cases, we'll prefer NPV over IRR. Second is IRR does not take into consideration the size of the project, while NPV gives us the absolute value. So it basically means, like, let's say for example, there are two projects. One has an NPV of 50 lakhs, the other one has an NPV of 500 crores. The first one has an IRR of 30%, while the second one has an IRR of 20%. So although the second project's IRR is lower as compared to the IRR of the first project, we'll prefer the second one because the amount generated, in absolute terms, is higher as compared to the first one. That's what I've written over there as well. The example, a small project with a high IRR might not generate as much absolute value as a large project with a low IRR. So using NPV makes more sense, since you are able to know in absolute terms what you will be able to make out of the project. And the last point is the reinvestment assumption. So under NPV, it is assumed that the cash flows are reinvested at the cost of capital. While in case of IRR, it is assumed that the cash flows are getting reinvested at IRR itself, which is quite unrealistic. While the NPV assumption seems quite rational. So that's why, in because of these three reasons, or in these three situations, we'll use NPV over IRR. There is one exception wherein we'll prefer IRR over NPA, and that is for firms or industries who have limited capital or their sources of funding is very limited. So for those firms who and who also have multiple investment opportunities, they need to rank them. So how do we rank them? So the best method for that would be IRR. So IRR would help in these situations in ranking different investment opportunities, and on the basis of that ranking we'll make our investment decisions. So this was all about the NPV and IRR. These are the two most important capital budgeting techniques which are often asked in the interviews, and very important from corporate finance perspective. So thank you for today. We'll meet tomorrow with another topic or another concept. Bye.